Today, we are breaking down 3 of the most popular NASDAQ 100 covered call ETFs. We're going to be looking at JEPQ, GPIQ, and QQQI, and what's been going on since the market shook in April after the first tariff announcements. I looked at the returns, how they got those returns, and where they might be headed in the future. And this comparison was very surprising to me, and it might surprise you too. And don't forget to stay until the end to see how I'm using this data to make sure my income portfolio continues to grow and thrive. And if that's what you're looking for, we're getting into that today. Let's go. Welcome back all, Rico here again with another ETF showdown. And first, let's look at total return and set a baseline for our conversation today. And this will help us get aligned so that we can truly compare these 3 funds. So when the whole market fell after the tariff announcements in April, these 3 were moving almost identically in lockstep. But as you can see here, something changed. JEPQ started lagging while GPIQ and QQQI kept pace and have almost identical total returns since April. And also I wanted to mention, just for reference, QQQ, which is what most people think of when they think of the NASDAQ 100, it's up 12.67% since April. But this is a traditional ETF and only has a rate of a 0.5% distribution, so pretty low. But look at this performance. So JEPQ has a total return since April of 2.95%, GPIC or GPIQ, which is 8.09%, and QQQI has a total return of 8.45%. So I'd love to hear, what is your guess? Why do you think JEPQ hasn't recovered as strongly? Drop your thoughts in the comments down below. I have my theory, which we'll get into a bit later, but I want to hear yours first. Also, let me know if you like the mic or no mic, because I kind of like it, but I can do it either way. Okay, let's look at these ETFs, current data, and talk about how they operate. As always, this is not investment advice. This is for educational entertainment purposes only. So made to inspire you, but always do your own research. Don't follow my recommendations. I'm just showing you what I'm doing. Always do your own research. And then a lot of this analysis was done using Snowball Analytics. I am an affiliate, so if you click on the link below, you can get a free trial. I will get a small commission if you do it, but I love Snowball Analytics. And if you want to use it for yourself, go ahead and do it down below. All right, back to the video. Now, let's look at these ETFs, current data, and talk about how they operate. So first up, JEPQ, which is JP Morgan NASDAQ Equity Premium Income ETF. It launched in May of 2022, which is the oldest of these funds. Its current price as of data recording is $55.62, trailing 12-month dividend yield of 11.14%, which is equal to a payout of $6.20 per share, and it has an expense ratio of 0.35%. GPIC, which is the Goldman Sachs NASDAQ 100 Core Premium Income ETF. This one is the second oldest. It launched in October of 2023. Share price as of today's recording is $50.95 with a trailing 12-month dividend yield of 9.85%, which equals an annual payout of about $5.02 per share, and has the lowest expense ratio of the 3, which is at 0.29%. And then finally, we have QQQI, which is a NASDAQ 100 High Income ETF, which is the youngest. It's the baby of the 3, which launched in January of 2024 with a current price of $53.70, a yield of 13.68%, and an annual payout of $7.35 per share. And it has the highest expense ratio of the 3, which is not bad. It's 0.68%. So that's where they stand today as a data recording. Now, let's jump into a higher level overview of how these work. Let me know in the comments if you'd like me to do an even deeper dive, but for the sake of time, I'm giving you all of the Cliff Notes version. I've done deep dives into JEPQ and QQQI, so I think GPIC would be the only one left, but hopefully you get enough from this video. So JEPQ uses ELNs, or equity linked notes, to create its covered call exposure. So really quickly, just so we get a line on what ELNs are, it's basically a private contract between the fund, like JEPQ, and the bank. And here are the 3 things that banks deliver. So 1, the bank promises to deliver returns linked to a stock or index like the NASDAQ 100 plus covered call income. And the fund itself doesn't actually own all the underlying stocks. The bank handles that behind the scenes. In exchange, the bank charges a fee baked into the contract, and the setup can limit transparency and flexibility compared to funds that hold the stocks directly, like GPICs and QQQI. And you can think of ELNs as like outsourcing the covered call strategy to a third party like a bank instead of doing it yourself in-house. And probably goes without saying, but my issue with ELNs is they're less transparent. You don't see exactly what's going on inside, and you don't get the same granularity on the holdings. And you're relying on JP Morgan's execution rather than seeing daily positioning that the bank handles. So for me, I like to see the sausage being made, and JEPQ does not do that. So the ELN model for me tells me why JEPQ might not be keeping pace with GPIX and QQQI. Just my thought. We can talk about it in the comments down below, but I want to move on to GPIX. So GPIX publishes clear holdings and their allocations. Now, they're not a perfect one-to-one match to the NASDAQ 100, but their profile mirrors it pretty closely, and this gives them some flexibility to tilt slightly within an index for yield and risk management, while they still keep the same overall sector exposure. So this could explain the slight difference in performance between GPIX and QQQI, and we'll talk about that a little bit later. We'll look at how they align to the NASDAQ. And QQQI, not gonna lie, this is my favorite of the bunch, is fully transparent, and we know exactly what they hold, actual NASDAQ 100 stocks. And they write index options on top of that. They manage their own books instead of outsourcing to ELNs, which means that they can be more nimble. They can adjust their cover calls based on the market conditions. So for me, gives me reason why they're outperforming JEPQ. So which approach do you prefer? The full transparency of holding the underlying stocks like GPIC or QQQI, or the ELN route like JEPQ? I'd love to hear your thoughts down below. Okay, so why the difference? Why has JEPQ trailed the other two since April? It could be timing and execution with their ELNs. If the ELN counterparts set call strikes too conservatively during the rebound, you cap your upside even faster. There's capped upside already with covered calls, but if you're outsourcing it, that adds another layer. With GPIC and QQQI managing their own covered calls, they may have given themselves more room to run when the market bounced. Without that full transparency into JEPQ, we may never really know the true answer to that question. So invest at your own risk, as always. And since we're on the topic of the holdings, here's a quick look at how the top 10 holdings compare between the actual NASDAQ 100, QQQI, and GPIC. And you can see that QQQI is almost a perfect match. You can see on the bar graphs, while GPIC tilts the portfolio a bit, holding some big names at different weights and leaving some of the top 10 out completely. So that slight difference in composition might also help explain why QQQI and GPIC have performed differently. Even though it's slight, it might explain it. So after digging into all this data, I decided to make a move. I had about $28,000 invested in JEPQ, and most of that position was carryover from a few years ago and earlier allocations, and then also I was dripping, so it built up pretty quick. But after doing this research, I actually exited my JEPQ positions. I put most of that capital into QQQI because I'm very bullish on NEOS, and I invest primarily for income in this portfolio. And the rest of that, which is about a third of those proceeds, went into GPIC, which is a new holding in my portfolio. And for now, I'm going to monitor GPIC closely over the next few months to decide if I want to increase that position, but I am very confident in QQQI as a core holding for my income portfolio. So there you have it, 3 NASDAQ 100 income ETFs, 3 different approaches, and 3 different results since the big drop earlier this year. I'd love to hear how you think about these 3 covered call ETFs. Are you still bullish on JEPQ after this? Will any of you change how you approach these 3 funds? Let's keep the conversation going. I'd love to hear your perspective. Comment down below, please. Let's keep going. And let's keep it kind, as always. And if you enjoyed this video, it does take a lot of work, so if you feel so inclined to give it a thumbs up and subscribe if you haven't already, I would greatly, greatly, greatly appreciate it. Thank you so much for watching. And remember, if it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care, everyone, and I'll see you next time. Boom.